1, 2, 3. Excellent. Yeah, we are live to today's panel discussion. Very happy to welcome 4 experts in their field from DeFi entities as well as from a CeFi entity. And today we would like to talk, we would like to make a little 2022 DeFi crypto recap. A lot of things have happened this year, quite some negative things, but certainly also some positive, I think, especially in the DeFi space. Before we dive into the real discussion, let's start with a quick introduction round. I would maybe ask you, Thomas, to start. Just quickly present yourself, tell the audience, please, what you're doing.
Sure, thanks for having me. Happy to be here. I'm Thomas, co-founder of Rudy Capital, a German-based investment advisory firm and software company. We're primarily engaging very specifically in DeFi market research, risk management, and portfolio construction.
Thank you. The next, Kirill.
Hello, everyone. My name is Kirill. For the last 5 years, I've been working at Nexo. If you haven't heard about us, we're one of the largest European digital asset institutions. Things we are best known for are crypto lending, but we also have now a full product suite of essential crypto finance products, a credit card, savings account, Nexo Pro and Nexo Prime, which are the trading product suite. And for the last 2 years, I've been the DeFi lead and been on a quest to replicate our services on chain.
Thank you, Kirill. The next, Token Bryce.
Hi, thanks for having me. So I'm Token Bryce. I come more from the community side of DeFi. I've been involved for the last 4 years, roughly. Started first just as a commenter, analyst, let's say, and eventually got involved in some projects. I've been working with Liquidity for the past 8 months or something like that. So Liquidity is a decentralized lending protocol on Ethereum, and what is widely regarded by the space as the most resilient stablecoin available to date. So that is also an interesting topic and what got me so fascinated about it. Anyway, looking forward to the chat.
Thank you, Token Bryce. And then last but not least, Nilos from Fiat DAO.
Hey everyone, I'm Niels. As Christian said, I'm a contributor to Fiat DAO. We've launched Fiat DAO about a year ago. We're a stablecoin that's fully collateralized on Ethereum. And I found my way into DeFi and crypto in general, actually, like back in 2018 through the first DeFi Telegram channel, which really was, a very small world back then. And, it's just amazing to see how that space grows.
Yeah, I also think that there's a lot more to come, especially in the upcoming years. I always keep a little bit comparing that, like, Bitcoin is now almost 13 years old, right? DeFi with 2, maybe 3 years is still in its infancy, and very interested in the discussion today. Before we talk about DeFi, maybe like as a little opening question, I think this was also already a little bit part of the last panel, but I also would like to ask you guys a little bit regarding that question. In the Bitcoin Genesis blog, right, there you can basically find a message, an encoded message, which reads the time 3rd of January 2009, Chancellor on brink of second bailout for banks, which basically refers to the financial crisis, right? And we recently had like this huge FTX fallout, and the contingency basically where like more companies are involved and are also facing trouble. What's your take on it, and what do you think Satoshi would think on that whole matter?
Well, I think he would have said, based on these events that we've seen in this year, and there were a number of those, right, where platforms have blown up. But he would essentially have said, I think, as a reaction to that, see, I told you guys, not your keys, not your money, right? and pointing out that the very principle of DeFi and crypto, right, is that you control your money with your keys, and as soon as you hand over your money to someone else, you're not in control of your money anymore. And I think what we see also with reference to FTX is one thing that crypto and DeFi brings is transparency, and for you to be aware where your funds are, even if you transfer them on a platform. I mean, I think that's one of the major value adds of DeFi too.
Mm-hmm. Somebody would like to add something, or shall I?
Yeah, I guess just to kind of brush it off, because it's been discussed quite a lot. But yeah, to explicit more maybe for less familiar listeners, the FTX situation is really a situation of comparable to the subprime crisis, or maybe something like Madoff, but something that has little to do with crypto and a lot to do with trust placed in human beings, failing institutions, failing regulators, useless certifications, and other, essentially failure of the whole control system around the financial industry. So that's the first thing to kind of state. And yeah, to be more explicit, DeFi would have actually prevented such a situation from unfolding, because in DeFi we have transparency. That's one of the core, I want to say tenets, but it's not a tenet, it's not a value. It's just provided by the nature of the technology. And so far, there is no way to do without it, essentially. But so thanks to transparency, we can see what goes into the packages, essentially. And, a lot of finance and DeFi is essentially, hey, I make a package with different stuff in there, and then I send this package to another guy who will make another package with it, and then another guy. That's essentially the subprimes. So problem with something like subprimes is you end up with a package of 1,000 package, and it's a lot of work to unfold it, if even possible. In DeFi, because of the transparency, it should still be work to unfold it, especially if it's this level of nesting, but at least you can do it with like publicly available information that anyone can access.
Mm-hmm. I very much liked that you guys said about the transparency. So basically, you can in DeFi always like have live data, right, where you can always follow up on what's currently happening within the protocol. I think that's also something I like very much about Liquidity, Bryce, because you can see all the different troves, and you can also see basically how they are set at which like price, and essentially you could live monitor Liquidity and LUSD. Also regarding the liquidations, right? This is something that's definitely unique to DeFi, but not yet so much available for exchanges, for example. I think we also
DeFi an amazing TV show. When it's blood on the markets, you just go and watch the liquidations. You can see everything happens live, which is quite crazy if you think about it. Yeah.
Mm-hmm. And do you think, or like to all of the audience, do you think that there will be in the future now measures which will make CeFi somewhat more comparable to DeFi? Like, I mean, like there was this proof of reserves, right, discussed, and many other things. I think myself and also the audience is probably very curious about how can I mitigate such risks, right? Also the central players.
Well, I can comment on this one, I guess. So the first direct order effect of FTX has been the push towards proof of reserve. I think also the things that are already coming out is that proof of reserves is not enough because reserves comprise of your assets and your liabilities. So then you will need a proof of solvency, which takes both into account. So I guess the main point would be both to trust and to verify. And luckily, there are tools that allow you to do this in a trustless manner, so that you can audit in real time individual accounts, their balances, and the user can come in and verify that their balance has the correct amount, and that also there's the corresponding amount of assets that are on the other side. So I think, I think Kraken are championing this discussion quite a bit, especially today. And the discussion becomes, okay, is it enough to just show you have enough Bitcoins or that you have an X amount of Bitcoins? Well, the answer is not. You need to show both assets and liabilities. The tools are not there yet to do it perfectly. There are initial attempts that you can do, and you can still improve upon them much further. But this is the main sort of solution to the problem, where you have trust, but you verify.
I think with like the proof of reserves, it became a big topic, and then suddenly we see that crypto.com apparently accidentally sent like I think like over 100,000 ETH to like Gate.io, right? I think this was also one of those incidents where people were suddenly like asking questions again, like how can something like that happen, right?
Yeah, I think it goes back to, you know, there is the element of trust, but you need to be able to verify, right? That information that is conveyed by some service or someone. And that's, I think, again, the whole point about DeFi having like an advantage, because just by nature of it, you have that whole proof of reserves and everything, because you operate in the public, right? Because you operate on that public infrastructure that everyone can monitor. And not only you, right? No one has to trust you as, let's say, a contributor to a protocol or a website of a protocol. Everyone else just, you know, spins up a dashboard, like, you know, the game dashboard about the protocol. And that's what people do, right? So there is so many eyes on what you actually do and what your funds do, where your funds are moved around. If you operate in the public, that it's like difficult to hide something. Whereas, you know, in CeFi, first, you know, it adds to your, let's say, operational expenses to offer that level of transparency. I totally agree, it's the way to go, and there are ways to do it, and I think, you know, like Nexo, you know, you have been very early with that you start, you know, first moves into that direction where you actually have, like, you know, a continuous audit, right? So you know, that can definitely be improved further, but, you know, I think that's the main observation from my side, that, you know, you just get it by nature of it, by building on top of a public infrastructure, versus you have to add that on top of your infrastructure.
I love this answer, because I think it brings some key terms to the question, which, like, so public infrastructure, for instance, all right? So if we can just take a minute to think about that, because I guess my whole point is transparency is not just a nice value, it's a security requirement for sound systems. End of the story. So to explicit this a bit more, think of a situation like the one we have right now on centralized social networks, where you have an algorithm deciding which post gets visibility or not. And this algorithm is made without any transparency, is not audited, and only the Twitter developers essentially know how that thing is working. There is no public debate on this algorithm, but it governs all public debate. So it's just an instance of technology playing a critical role in society, if we're honest. And we have zero control, oversight, transparency, acknowledgement, whatever over it. It's just a black box. And I think this is why, you know, why this is so fundamental that DeFi operates on this transparency, as, you know, transparency is part of the package, and there is no way around it, except, you know, in zero knowledge-based systems and other specific use cases, but it's by far the default. And so, you know, to tie it back to risk assessment, the very first step when you're doing a risk assessment is to get a sense of the scope, as we call it. So essentially, what are all the exposures? Well, I fail already if I try to do this on a SEX, because I have no idea where the funds are. And, you know, this is also one of the lessons from the FTX blowout, which is how many services were actually exposed to FTX and customers had no idea about it. They were never told that, you know, this exchange, if you use this exchange, it means you essentially use the wrapped FTX. They didn't know that. So they didn't know that, and they couldn't know that unless they were, having insider information. So yeah, keep that in mind for when you hear people talking about transparency and finance. Anyone having the slightest stance against transparency is essentially saying, leave me the right to embezzle, potentially.
I totally agree. I think there is also something I would call a perceived transparency, right? So transparency is not an easy thing to create, because in the end, transparency could mean to just make some information public, but that information must be trusted, right? And that's and it's very, very easy to misguide people out there and make kind of a perceived transparency. So if you build on top of a blockchain, you can eliminate what you can't eliminate ever in a centralized world. So that's where regulation typically steps in, right? With auditors, with all kind of standard processes and requirements and so on. But in the end, you have Wirecard and any other examples that confirm over and over again that system cannot be perfect in that sense, because it doesn't rely on a technology that can create that environment itself. So yeah, I'm very, very curious to hear on Kirill's thought on how Nexo is gonna plan on doing that. Talking about proof of reserves, liabilities. I mean, how do you get liabilities? For example, on chain. So you rely on probably a lot of IT systems that are not connected to the chain, right? To regulators. You have a lot of information in your bookkeeping systems, and so on. So I'm not very much into that, but I would be very curious to learn how you want to make, or how you want to create that transparency, and how you want to make that transparency really trusted.
Okay, so I don't claim to be an expert on how we're doing it today, but I'll give you the short version as far as my understanding goes. Basically, the current audit we have every morning takes all accounts into consideration: cold storage, exchange accounts, and bank accounts. So when you have a fiat infrastructure, you cannot have on-chain audit of our bank account. You cannot have an on-chain audit of a centralized exchange account. So we need to connect via an API. Then when you take those into account, it happens that today, it could happen that for an hour, the API connection doesn't count all the assets, or one asset is not supported. So this is an endless and constantly going effort to have all assets, all currencies, all accounts. If you make, let's say, a new exchange account, this has to be added to the audit on a daily basis. And yeah, this is a really consistent effort, nonstop, and it has gone for a year and a half, I guess. It will continue in the future, and it can be improved. I think Merkle trees are potentially the way to go, but I don't have, let's say, this is not something I do on a day-to-day basis. But it's a good start. It's, I think, as far as anybody has gone in the space. And also keep in mind, when you are an exchange, essentially you have to keep reserves on a one-to-one basis, right? Simple as that. However, the first second you start to do margin lending, as Binance, for example, you already have lent out dollars against Bitcoin collateral, or you have lent out Bitcoin against dollar collateral. And now you have less than 100% of what the customer has deployed, because you pay them an interest, just like on Binance Earn, and you are giving them to the customer to trade, and they might convert them to another currency. So from that perspective, as business models evolve, so does the requirements for audits and for reserves. So my, let's say, my skeptic, let's say, prediction will be that the larger the business, the more complex it is. I'm including Binance, including Coinbase, to a lesser degree Kraken as well. The harder it gets to audit everything and to give perfect information to the users. At least at this point, right? So there's no out-of-the-box solution. You have to go make it yourself. Yeah, that's my 2 cents. Again, I'm very, very far from the effort that goes on there. I just know it's a daily grind to make sure that all accounts are connected.
So to follow up on this and tying it back to my previous point on the transparency, as a Nexo yield user, say I give you DAI, can I have a transparency regarding what is my actual exposure, you know? Like putting DAI into Nexo means this much is going there, this much is going there, this much is going there. Is there any kind of mapping like this for the investors?
I don't think there's any way we can address this today, because let's say your DAI is not deployed directly on our platform. We lend USDC and USDT, so we might convert it to USDT or to USDC, whatever customers need today. It's also hard to make all systemic exposures, right? So if you use an exchange, you can say, obviously, the liquidation engine uses Binance, it uses Coinbase, and that means some kind of reliance on other companies in the space as well. So we can be open about saying, okay, we don't have an order book, we rely on other exchanges, and it's a matter of you as a company being aware of where your dependencies lie, just like a protocol. If you have any kind of algorithmic deployment of protocol control revenue or treasury, you have exposure to, let's say, to a curve pool with other stablecoins, and you have exposure to DAI because you have a DAI LUSD pool, for example. I don't think anybody can understand better exposures than the way we can, or the builders in the protocol can. And I'm sure Liquid is also as much aware of its weaknesses and better than anybody else, actually.
And they are disclosed in the documentation, fully listed, linked to smart contracts. Anyone can audit them. And if we are asked about it, we disclose the full risk and the full attack vectors completely. And this is what DeFi is about. Just kind of, it's too bad I can't screen share, but I just wanted to show, because I think a good thing to have in mind here is, so in my view, Nexo acts like a Yearn, but CeFi version. So Yearn is an aggregator where, as a DeFi user, you go to Yearn and you give them USDC, and they will tell you, okay, we can secure 4% yield on USDC, and this is how we do it. And they give you the full list of strategies. Currently, about 15 different strategies are harnessed on USDC, and you have the detail and the performance, the allocation, and the risk model for every strategy on their website. So, you know, this is something that can be done already. DeFi can do it, and DeFi doesn't have the means of CeFi.
So maybe now because we have already spoken so much about FTX, maybe let's switch a bit more towards the direction of DeFi, because what I'm hearing all the time, we should be super bullish on DeFi actually, right? So basically right now, I think everybody should expect that on Uniswap, SushiSwap, or on any kind of DEX, we should see like spikes in volume and everything. But I think it has not yet been the case, right? So how are you guys seeing right now the positioning of like DeFi? Is there even like, yeah?
Yeah, just sorry to interrupt you, but you say it hasn't been the case. I'm actually not sure about it. I mean, what I see are flows of users into, you know, wallets, right? Where, you know, you hold your keys, you know, your funds and stuff. So you see a large user flow into these, you know, DeFi services, and also actually DeFi platforms, you know, like specifically what we see, for instance, into perp platforms. You know, I mean, FTX was a perp platform, DeFi version, and now we have and an uptake of volume on DeFi versions of per platform. So I just wanted to make clear, I actually think we do see DeFi taking over some of that volume that was previously on CeFi already. And again, I do totally agree that I think this is bullish for DeFi. I think mainly also because just what we said before, there is by nature of things a trust element involved with DeFi services. And that trust element actually puts requirements also for like different types of regulations for those entities and institutions, which do put cost on those services, right, and service providers. While I do see that DeFi services and regulation for DeFi services, it will also become stricter, let's say, or there will be different types of regulations that we don't yet see or know yet maybe. But again, just by nature of the thing, the regulation for DeFi services will look different and can look different from CeFi. And so that's where I'm like long-term bullish on DeFi too. And then, like at the same time, I actually do see that it's not one or the other, right? There are services to certain types of users that will be provided by CeFis, and that's beneficial for the whole space, right? Because it allows the whole space to actually grow beyond, let's say, like very tech-savvy users, right? So I do see a future where there will still be CeFi service providers, and they have their place.
Fully agree. Just a quick one. I think the difference between CeFi and DeFi is a difference in nature. So, DeFi and CeFi can provide similarly, functionally similar product like an exchange, but it's not the same product. A DeFi exchange, a DEX, is not the same thing as a centralized exchange in terms of both enable you to swap tokens, but they provide vastly different guarantees and risk models to the user. And so we should not forget about this massive qualitative difference, not quantitative. So it's important to look at the numbers and be like, oh yeah, look, decentralized exchange are doing X% of the centralized exchange. But at the end of the day, again, $1 traded on a decentralized exchange is not the same as $1 traded on a centralized exchange. On a decentralized exchange, I can audit the full order book all the time, all the pools, and see this actual dollar traded on chain. On a SEX, I'm trusting at the end of the day, someone somewhere telling me, yeah, bro, we traded $1.
And so token brief, maybe, the reaction to that would be the question, so why do, like, let's say, centralized exchanges exist then, right? And of course, the answer is UX, right? And a different type of quality, which speaks more to certain types of users, right? At the moment, there is still an edge in actually going through, a centralized exchange for reasons maybe of like, the on-off ramps and stuff like that. But that's an area where, DeFi can still improve too, right? On the one hand, but then also on the other hand, again, I see, that there is a place in the future for centralized services.
Yeah. Now that we have criticized centralized exchanges so much, one point from my side, especially for Uniswap version 3, it's a case that those liquidity pools need a constant rebalancing, right? So Uniswap is price taker and not price giver, right? So essentially when, for example, on Binance, the price for Bitcoin changes, people will arbitrage the Uniswap pool and basically by that also provide them their liquidity. So my question would be, is there even DEXs without centralized exchanges? Because what would happen if there was no means of rebalancing?
It's just one model of liquidity concentration used by one DEX, and you can still create a maximized availability pool on Uniswap. There were DEXs at the same time as there were SEXs. They both grow on, I want to say, a separate track, but still connected. I don't think, they have interactions, but it's Uniswap V2 essentially, or even V3 will run as long as the Ethereum network runs. So all the SEXs can blow up Uniswap don't care. There will still be pools, and as long as there is liquidity in those pools, people can swap. The price might be ugly, the liquidity might be narrow, but people will be always able to swap.
But do you guys think that this is something that the user is? I mean, I totally get it. We have here like a total trade-off between like best pricing, right, on like centralized exchanges, but then on the other hand, we have like the security essentially of DeFi, and I think there's like a trade-off. Like that's also how you guys see it a little bit, right?
There is always this trade-off, right? I mean, we don't create, for instance, like, whatever we do in DeFi, there is the D before the Phi, right? The decentralized, stuff. And we don't decentralize infrastructure because we optimize for, I don't know, UX or for efficiency. It's actually we optimize for robustness, right? And so there is a price to that. And again, there will always be users that actually want to optimize for something else. And so that's where these two worlds will always coexist.
Thomas, did you want to say something?
Yeah, I just wanted to add to the point of user experience of centralized exchanges and so on. I think that's probably one of the most popular and probably truest points at the moment that holds many users from actually using DeFi, and that especially in combination with custody, right? So custody and user experience are very much intertwined. And if you think about it, just if you take the perspective of a somewhat maybe tech-savvy person, but not too much, not very familiar with the space, you have to learn a lot about all kind of different wallet types, right? Their pros and cons, and how do I get started, and how do I get my money into crypto, like the on-ramp process that we talked about. Very, very difficult for someone that's new to the ecosystem. So I think centralized players play an incredibly important role in onboarding customers and making them familiar with what that space has to offer. And I have many friends that really, I encourage them over and over again to try it, but they need a lot of guidance, and they don't feel very, very good with the wallet solution. Let's just say you go for a hardware wallet, which is the most popular one and recommended by everyone. But then you have your hardware wallet. You have to take care of it. You have to store it. You have to make it fireproof if you hold significant assets on it. You don't have to lose it if you move from one town to another, and so on. And then every single transaction that you make must be approved by the hardware wallet. Doesn't matter if it's just a single token approval or the effective swap in the end. So that's really a hassle for people just starting with DeFi. So yeah, I think that's where centralized parties can play a vital role, and that is probably going to be their role in the next couple of months, if not even years. And then there is the regulatory aspect as well, right? So how can you effectively regulate DeFi? That's a tough question, because they are typically not in jurisdictions that are easily accessible for legal prosecutors and so on. So the on-ramp process through centralized regulated parties will probably prevail. And then the question for the future would be, will some of the services that CeFi today provides be actually accessible in DeFi with the same user experience? Or do we really always have that trade-off that Nilus was talking about, right? Is this going to be a trade-off that just gets smaller over time? Do we eventually get to a point where this trade-off is gone, which I actually question because of the nature of the technology, right? So let's see. But from my perspective, there is a lot of unsolved user experience issues, inclusive custody, that prevent a lot of users from using it.
I do agree, with what you said, Thomas. One point, maybe I wouldn't recommend a new DeFi user to start with a hardware wallet, right? Probably use a more simple path. And I've been thinking about that question too, right? Why is it that people have difficulties with UX, around wallets? There is actually, if you look at Argent, it's such like a simple and great UX, right? It doesn't cost you to set it up. It has on-off ramps directly. You have social recovery, like, you don't have to actually care about seed phrases and stuff. And so it's such a great UX, really, to be honest, right? That, it can easily compare to, let's say, an exchange, right? A centralized exchange or so. So where does it come from that someone new to the space still like is hesitant using that, or would prefer using something, some like a centralized exchange? And I think the reason is that people don't yet understand like this concept of let's say transparency and decentralized nature of stuff versus something that's regulated, where I can trust that, again, like a regulator actually has their eyes on the exchange that's offering those services, right? They are actually more convenient, like more, familiar with the concept of trust than like with the trustlessness of something that's built in the open and runs on like, public infrastructure.
Yeah.
Well, I think it's going to be quite mechanical, the transition in people mental models, essentially, about resilience, safety of the services they use. To put it simply, as more and more states, control system, auditing, and whatsoever regulatory systems are failing. I mean, I think it's quite obvious now. It's not controversial to say that regulation is failing all around. It's getting violated. It's getting, it's not equal anymore. So there are people able to avoid the law, like potentially FTX, some or others, simply because of their status and connection. So all of this really shows that those control systems, they don't have their check and balances anymore, and they don't work. So unless people are manipulated or insane, which two are both possible scenarios, I see them as progressively evolving towards, I don't want to trust people, I don't want to trust entities anymore. Oh, hey, I have a tech that enables me to actually revise my trust models and interact with complex services without any time trusting an actual person to do the good thing. That's really powerful. And, we're just pushing the boundaries of this. So like, just to give an idea, recently there was this Aztec ceremony for a privacy stuff, essentially, to keep it very high level. But the really cool thing about this ceremony was, it was a ceremony to launch a system. And essentially, it's a system made so that as long as there is one honest actor, the system can be trusted. And so I was amazingly cool, because it means that anyone who participated to that ceremony know for a fact, like mathematical guarantees, that the system can be trusted. Because they consider themselves trusted, obviously. So this kind of model, I thought I was quite crazy. Do you know of any system in the world where you have this kind of guarantees? Like, we accept very weak guarantees for highly critical system all the time. And I think this is the core shift that will happen eventually as crypto and Web3 DeFi propagates.
I would have a question to that, because I'm, for example, also a lecturer for a bachelor, and we did a little bit of smart contract programming with students and so on, and they really got a good sense of what it means to what a smart contract is, what it's capable of doing, and so on. But it's very hard for people to connect, like, okay, I see what's technically capable, but how do I as an individual know that I can trust that code, right? Isn't there some sort of expertise needed to do that? And then you can say, well, that might be true, but there's a lot of people using it. That could be a trust factor. There are auditors that audited exactly the smart contract and so on. So how would you say, as builders out there, how would you try to educate people more on, why it's easy to trust a specific smart contract? How do I myself gain that trust that that contract is actually doing what it's doing? I know it's self-evident for most of you. It's self-evident, but people out there, a lot of people don't have any idea of code, right? Or smart contract code. So what would be your suggestion?
So you don't need to even touch the code. So I barely started to look at the solidity of protocols I'm auditing, let's say about 8 months, a year from now. I did 3 years of DeFi analysis without looking at a single line of solidity. And with that, I was already able to anticipate hacks, anticipate failing protocols, and so on. So my point is, you need to stop overcoming this perspective of it is technical, I need to be a dev to understand what's happening. That is simply not true. The perspective I had and still have is those are systems. They are designed, they have different components. I might not understand the code of that system, but I can understand the components and how they interact with one another and how they react to external forces like the market. So, to put it simpler, on something like liquidity, you maybe do not need to understand the solidity code that makes liquidity work. That is ideal if you can understand it, of course. But to me, it's more critical for you that you understand the high-level infrastructure of the protocol. Oh, okay, so it's a lending protocol, and so there are troves, which are where users borrow. They borrow against the protocol, LUSD. Oh, okay, you have a stability pool that is used when there is liquidation, recovery mode, all those concepts, connecting them together. And essentially, can you tell me the story of the protocol you're using? That's a good tell, of this understanding. So like someone that has this understanding on liquidity can tell you the story like, oh, okay, so this is how liquidity works. This is how it is right now with the current ETH price. But ETH, for instance, I don't know, ETH dumps 50%, then we go into that zone. That means the recovery mode is triggered, which means minimal collateralization goes down, which means we see a lot of liquidations, and then eventually it stabilizes, and the system will maintain its collateral ratio at all time. So, you see, it's like you go from someone telling you the system will maintain collateral ratio at all time to, okay, I know how it maintains collateral ratio at all time. I don't understand the code, but if ETH price goes down, I can tell you what happened. If ETH price goes up, I can tell you what happened. And then, you essentially have a decent full picture.
So your case would be, or your suggestion would be to conduct research maybe through observation and experience, right?
So, I agree that you don't necessarily need to understand each line of code, but I also think if this is the requirement for people to start interacting with a product, we've lost a lot of users that you would actually want to use the system, right? Mm-hmm. And so I think how it in practice works probably is, you start building trust based on different things that you observe like outside of the system itself. So one way is you have Twitter personalities that shill a project, right? And you start trusting that just because those people actually shill it doesn't mean it's actually, good. You've seen it with Terra Luna, for instance, right? I mean, it was hard to really, even on Twitter, even if you were critical about it, it was hard to really get your word out, right? Because there was such a strong army of people actually defending it. So this is one, I think, mechanism of how people start trust projects or protocols, and I don't think it's actually a good one, right? I think one simple approach may be, to say, look, if the project has been live for 2 years or whatever, it has survived a number of, market downturns and events. I start trusting that protocol that it actually works properly, right? Mm-hmm. So I need, so it takes a while until I actually start using it. There is also, it's probably not that easy for everyone to assess that. But I think that's probably in my opinion, one of the kind of the approach that requires least understanding or least efforts from people to assess kind of, the trustworthiness of a system. And I think, to be honest, that is even an area where we, as the DeFi industry, need to do better. Also, in terms of some sort of self-regulation, where we have certain bodies or I don't know, metrics or whatever that help make transparent risks in certain protocols, right? So yeah, I think it's an important area for the space to be able to grow. So we need to improve there.
I mean, it's coming. Just a quick one. But Chris Black, for instance, launched a few days ago Black.report. And it seems like he's really exploring this angle where so far he only has 3 protocols, but it's really like super short content considering, you know, what he's presenting, about 300-400 words, I would say. And he's really like taking a protocol and being like, okay, they do this, so this is your main risk and you need to worry about that. And they also do this, so this is your main risk, you need to worry about that. So, you know, clear mapping. But just to add to answer your question, Thomas, another thing that I think is important is we all have expertise before crypto. So use them, because a crypto project is a cross-expertise project anyway. So to explicit this quickly, a crypto project involves people. Maybe you know how to stalk people, figure out tons about their life, what they did in their previous projects. Are they reliable? That's one thing. A crypto project needs a website. Maybe you are a website developer. You have some clues about that. Is the website optimized? Can you audit the website? Because if the guys can't build a website, can they really build a protocol? You know, a crypto project needs graphics and design. Maybe you are an artist yourself. Look at what they have done. Does it make sense to you? Have they overpaid for this graphic or design? You know, you can essentially evaluate them on so many things. I use your own expertise. So for instance, for me, one thing I do a lot lately is evaluating projects based on their liquidity management strategy, simply because this is my expertise in DeFi. And so I can quickly tell if a project is competent or not, if it has someone competent in DeFi or not in the team, within 5 minutes of looking at their liquidity strategy. I find some projects that are overpaying by 10x.
So, yeah. I think everything you've said so far, you can imagine how much it resonates. I actually had the same exercise for liquidity, just our team jumping on and talking about, okay, what happens? And in a particular future, this is a particular scenario, what will happen? Peg goes down, peg goes up. I think imagining alternative realities is the way you risk manage at all levels. And my background is in economics, so I've been trained to talk about flows of money between economies. So I always imagine a protocol being a crypto economy. Money flows in, money flows out. It has an export, it has an import, and this sort of thinking has been very helpful. And to summarize, I think the whole conversation, because we said a lot of things, the 2 main aspects are, you have economic risk, right? Economic risk is probably even more important than technical risk, because even trained developers, auditors, they miss stuff. So worrying about the quality of the contract is obviously, if you have a CTO level guy that can look at the code, they can tell you, is it written well? Does it have vulnerabilities? Something that has broken somewhere else. But even the simple logic of, let's say, a lending protocol breaks by Uniswap oracles. If they use a Uniswap TWAP on a low liquid coin, that's a common problem, right? So you don't need necessarily the technical skills to already avoid the most risky projects. And the third one is obviously the team risk. Is the team competent? And also, how aggressive is the team with their growth? Usually, aggressive growth comes with aggressive trade-offs. Are they at any point sacrificing more exposure to more protocols in any capacity to grow faster? And one final thing I wanted to say before we jump on the next question is basically, protocols are moving, have a lot of moving parts. So that's what I wanted to stress again, is that basically you have an assumption, which is, let's say, liquidity is safe, but always keep in mind the moving parts that can indicate that they're no longer safe. And this is your protection against the Lindy effect.
The cool news is there are no moving parts on liquidity. So if you deem this safe at once, it's safe.
So no moving parts.
But it's an exception. I agree with your thought process. So it's just being a bit.
Let's say so any other long-standing lending protocol. Let's say the assumption might be, you know
Maker,
what?
for instance. Yeah, anything that
let's
can
take
change.
Aave from last week. The assumption is Aave is safe as long as there's liquid markets for CRV, for REN, and so on. And this assumption has changed, so the risk management team had to jump in and stop lending against the protocol. So this is an assumption that has changed over time, and this is something you can infer from the token design, from the protocol design, not the token design, that you can flag as a moving part that can change, moving part that you need to be aware of. And once it happens, you know, okay, it's happening, I better be prepared. So yeah, that's the way I look at it.
Yeah, just to add to that again, I mean, what we talked about does require time and effort to actually conduct, right? Risk management is nothing that happens in itself. And as you say, Kirill, right, it's a process. It's not something, it's not a one-off assessment that you do, right? And so that's where naturally trusted parties come in, where people actually entrust the risk management capabilities to those parties, you know. And so products and services that make using DeFi easier for certain types of users who don't have the time or don't want to invest time in those practices. And I just think, you know, it first of all creates this area where there will be trusted parties interacting between certain users and DeFi. So it just naturally there will be like business for those types of services, and at the same time it puts a lot of responsibility on those parties, right? Because people entrust you with that very critical role to actually make this, you know, risk assessment and continuously making that. And so it's just an incredibly important job for, you know, these parties to actually do properly.
Yeah. I think one big problem is that almost no risk model has a sufficient validation, right? So we're building risk models ourselves, all different kinds of risk models, and you essentially get to a point where you have to weigh different categories, right? And once that starts, you're digging into assumptions and more assumptions and more assumptions. And do we weigh smart contract risk at 25% or 35%, right? And so on. And that's where it gets really complicated, because you don't know if your model is better than a randomized model, so that you randomize weighings, for example, between the categories. And eventually, maybe coming back to the point of mass adoption and young or novel users, they need a certain type of curated experience, and that's where trust comes in again. That's you need to trust people in the end that do that on behalf of you, because you might not, you know, be like Token Bride's very experienced and looking at liquidity management or protocols, or Nilus or Kirill or whoever has, you know, years of experience digging into things that are important and relevant. So I would be very curious what your thought on that curation layer would be. And Nilus, I think you mentioned Argent earlier. I mean, that's a type of curation or curated experience, right? You have your app, you have an on-ramp, you have social recovery, good user experience. And I think they also include popular projects like Uniswap, if I'm not mistaken, a few popular lending platforms and so on. So, but then we need to trust them again, and then we have ultimate money, right, with a new wallet. And
but yeah, I think there is one difference though, right? I mean, I do agree, it's probably the first filter, right, for let's say new users, and the first element of trust. You trust that curated list of services that you want to interact with, right? And Argent is a great example, because they have like a very select list of DeFi protocols they let their users by default interact with. But then, like, the difference here is that as a user, I can enter, let's say, the power mode, and as I trust more protocols, I can interact with them. Again, I own the keys, I own like my funds, and so I decide if I want to actually look beyond that curated list. And you know, another simple example is just Uniswap and the tokens that they let's say, allow you to swap into by default, and then you can just add any other token that exists on Ethereum or you know, whatever chain, if you really want to do so. And so what you see is warnings as an element to actually, you know, communicate risks, right? A very simple one. But you have the ability to actually decide yourself what you want to do with your funds.
Yeah, creation has a price essentially, and I think it's good that there are more efforts put towards creation. But what I'm more enthusiastic about is more I want to say those type of public resources helping people better navigate this information. So, you know, we mentioned the Black Report website recently launched. That's one. Earlier, Kirill was making a very, very valid point regarding the development process of projects. You can assess that with DeFi safety, but keep in mind his warning, which was essentially, you know, the development practices can be very thorough. So the thing can score a 97% or 95% on DeFi safety, but the idea can be economically broken, essentially. That is, for instance, Bancor. So Bancor was stellar at code reviews, management, audit, whatever, you name it, they were doing it. But, you know, the idea was economically stupid and flawed from the get-go.
Very common issue. You're dependent on the project token. This is the first question you have to ask yourself: is if the token goes to zero, is the project going to work the same way it does today?
Yeah.
So just like quickly, we had at the beginning like a little bit of criticism towards CeFi and sexes, but what I'm also now hearing now is basically with DeFi, we have other type of risks. We have maybe transparency, but what I was just hearing, for example, was something like from you, Kirill, like governance risks, where my favorite example is always Wonderland, where they did those DAO votes, which never got enacted because nobody has a token power. There was no on-chain voting, right? Then I think Thomas said we have technological issues where people just don't understand the code. And I would, to a certain degree, agree with you, Token Bryce. However, there's also very, very young protocols where there's not a website with faces on it. Like, I mean, Liquidity has like very reputable names on the website where I know I can trust those people. But in DeFi, I think we should also just trust the code, right? And if there's just code on the blockchain, some anons with some, I don't know, NFTs as like profile pictures on a website, there is not the sense of like feeling I can trust those people, right? I mean, they're not even like showing their face. And then I think the third one is also the risk towards economical failure, right? What we saw with Luna. So that basically people use smart contracts to build certain mechanisms where they fail at the end, right? And I think very often it's not so visible on the first side.
So I mean, it was obvious for Luna. It's more, you know, the smart contracts themselves did not fail. It's more of another instance of Bancor for me. It's, you know, the base economic model was flawed. We knew the only outcome for a such system, if you map it mathematically, was to blow up. The question was when. But there was no way this thing could have sustained long run, be it Bancor or be it Luna, because essentially those were systems that were working very nicely in regular situations, you know, like super efficient. Yeah, go for it, nice yield whatsoever. But the problem is they were showing massive crackers in stressful situations. So yeah,
but you're talking about the impermanent loss, right?
No. I'm just talking about, you know, essentially the way the Luna system was designed. It was not made to stomach a bank run. And from the very basic design of Luna, it was actually susceptible to a bank run. And the whole question about Luna was a matter of how much UST there is in Anchor versus how much there is in the pool. And the problem is this ratio was 20 times more in Anchor than there was in the pool or something like that at some point. So essentially only 5% of the users could exit. You know, and that was like all on chain, verifiable by anyone.
Yeah. We are closely already coming to an end. However, I think there's still a few questions. One would be, does DeFi need a central bank? how do we survive liquidity crunches in the future as the ecosystem continues to grow? Fiat can always be saved by the central bank. What's your opinion on that?
We already have a central bank in DeFi. That's a lender of last resort. Would probably have been helpful in the case of centralized entities blowing up. And then the question remains, if there was a lender of last resort, should they have saved such flawed entities, such as FTX? The answer is probably no. Yeah, I think the main point is it necessary, first of all? And then what mandate should they have? And three, what function should they serve?
Mm-hmm. Somebody wants to add something?
Okay, no,
otherwise,
it's a clear no from my side. There shouldn't be a lender of last resort or a central bank in DeFi. I think one interesting concept that's been formulated more this year is something like a clearing DAO, which allows for the one-to-one conversion between different stable coins as one element that makes DeFi safer, let's say, right?
Nihilus, I think here becomes the main question of changing one risk with another. So, for example, the PSM is already a mechanism like that, the MakerDAO mechanism. And now it makes DAI susceptible to USDC stability.
Right.
It makes it susceptible to GUSD stability. And you cannot have such a clearinghouse without stablecoins being having exposure to one another.
The question of course is how interchangeable are stablecoins, which would be accepted into that clearing DAO. Totally agree. There also is governance, and so that all would have to work out. But like I guess my main reaction is no central bank. But there are elements where we can make the system more safe. A clearing DAO would be one element that could have prevented some escalation.
Yeah, I think the problem also is that we don't have good research, right, or very well-founded research in the space yet. And obviously, innovation has a lot of pace, and research lags a little bit behind. So all those parameters of innovation and trying out new things, experimenting, are a high risk undertaking in the space still. And I think there will be a much larger let's say a lot more research in the future that is conducted, especially already in Switzerland and in some Asian countries, that provides guidance based on observations and experiences. And I think a lot of crises that we've experienced, especially 2022, will be able to provide good input for scientific studies that will help along the way and provide maybe some guidance in finding truth. Let's put it that way.
Mm-hmm.
Yeah, now is a good time to become a risk researcher, I think. And the events have proven to you that this skill is in dire lack all around the place. I think that's quite obvious. And maybe I won't end this on this closing thought, which is, we talked about the curator of the risk management, risk assessment earlier. You will pay that price if you're not able to do risk assessment on your own. That's the first thing. But the second thing is, this is a very young space with mostly uninformed investors and uninformed builders. So what do you think it looks like in terms of risk-weighted yield opportunities? Because every day I'm finding massive discrepancies. I'm talking opportunities that are 20 times overpaid, or other opportunities that are 20 times underpaid compared to my own risk model, of course. Maybe my risk assumptions are wrong. But just to show you that this is common to find a 20 times spread, not 1 or 2 times, 20 times. Can you imagine? So on one side, the guy is earning 5%. On the other side, we're talking 100%. They're taking the same level of risk in my assessment. So long story to tell you, if you're able to risk assess on your own, you have direct access to the gold mine, essentially. And even if you don't want to do this on your own, you have hundreds of people who want to dig gold and they don't know how to do so, and they will hire you gladly. So if you have the remote interest for risk in DeFi, jump all in, quit your job, get retirement, and get straight into it 20 hours a day. Can guarantee you that if you do that 6 months from now, you're probably helping some DAOs, some protocol, some DGens, or having a newsletter or YouTube channel, who knows, where you help people learn, understand, educate themselves on risk. And they will thank you for that.
Okay, then now my last question towards you guys. Maybe you can just answer within like 20 to 30 seconds. It's maybe like, I'm not the biggest fan of token shilling, but maybe you guys can name me your biggest winner in the DeFi space of 2022. And just briefly, like 20, 30 seconds, why you think that this protocol has basically excelled this year in terms of services or performance, or as you like. Maybe Thomas, you can start.
Yeah, there are a couple. I'd like to mention GMX because we've used it a lot and put a lot of thought into building strategies around it. So I think it's a great alternative to centralized exchanges. Although it obviously has some potential weaknesses that are heavily discussed in crypto Twitter, right? But it's always the case for new products. So let's see. But I think it provides great opportunities for traders and liquidity providers alike, right? So we've successfully deployed delta neutral strategies around it, netting around 25% annualized with almost zero volatility. Of course, you have to benchmark it against the risk. There we are again, right? But there's a lot of liquidity flowing into the protocol, proving that there is a significant user interest. And yeah, overall, I think it's a great project that we should have a closer look on.
Thank you. Next one.
I want to open it a little bit. I mean, I say Ethereum as like the base protocol. We've seen more and more kind of cross-chain activity this year. We've also seen, other chains or, Ethereum killers failing or not keeping their relevance as they had initially with bootstrapping phase. So I'm just very bullish for the whole Ethereum ecosystem as the home of DeFi, right?
Thank you, Niels, and maybe Kirill.
Yeah, so I think on the protocol level, it's very hard to say who the winner is compared to last year, just because activity has gone so much down, tokens are down, and I think I'll take a different perspective. I think the winners are forged today. So anybody that has enough runway to survive 3-4 years bear market, anybody that's making the next version of their protocol with better market fit, better risk management, these are the winners. I think on the protocol level, DYDX is one example. On the product side, have done really good in terms of the UX, just the usability of trading perps. It's great from the perspective of the user. But I think the biggest winner and the only clear winner of 2022 is Ethereum. The merge, I think, is the single best tokenomics upgrade in the whole history of crypto economy. It's done so much to improve the asset as a currency, as a hard form of money, being deflationary for a few weeks, now back to inflationary, but it's 0.03%, maybe something like that. It's done a lot to align incentives for builders, validators, and investors. And even the staking mechanics, the staking economics now are so much better, as the rewards go into the long-term believers, like the people that are willing to lock up their Ethereum potentially forever, right, until withdrawals are available. So big winner, Ethereum. And on the protocol layer, anybody that's here 2 years from now, and is working on their product market fit, I guess.
Mm-hmm. Thanks for your advice. And then last but not least, Token Bryce.
Yeah, I agree. I would just add maybe at the protocol layer, there is some clear winners of the FTX fallouts. And those are essentially, DeFi as a whole for two things. First, think about who was repaid first in terms of loans that FTX was owning. Not real world entities, not other CeFi projects. They paid back their loans on Avi and other DeFi protocols first, because they know that with protocols, there is no fooling around. There is no, oh, don't worry, I'll pay you back next week, or please give me some more, or whatsoever. So that's the first thing. A second is for, when the liquidation fiesta was happening, the liquidity for those trades was sourced on Curve mostly, and also a bit on Uniswap. So in the wake of the blowout, and every time there is massive panic movements, essentially, Curve is usually printing record volume. And this was the case another time. We had, I think, several days with over a couple billions of volume, I think, or something like that. It was really like sizable amounts being traded on Curve. So yeah, another angle is, look at the activity spikes in those moments, because, essentially when the market is panicking, activity is kind of spiking, but only on certain areas, which are the most resilient, the most available protocols. So it's a good term to see which one they are.
Mm-hmm. Yeah, I also like to see that basically DeFi was basically strong enough to withstand like several crashes now, right? I mean, DeFi is just working as intended. The code is still there. The money is still there. So there's, I think, a lot of hope for the future that this space will just keep growing. And this already to wrap it up. It was a pleasure to have all you guys here on the panel. I think it was a very insightful discussion. And I hope the audience also enjoyed it. I want to wish you guys still a nice Thursday, nice Friday weekend, and let's talk soon again. And then I want to say goodbye.
Great discussion. Thank you all. Thank you.
Yep.
Well, thank you for being here.
Bye. Thanks for
Bye, everybody.
Bye.